If you're watching silver right now, stop scrolling for a second. Something just happened that you almost never see in modern commodity markets. I'm talking about a roughly 34% collapse in a single session, billions in value erased while most people were still trying to figure out what triggered it. But here's the twist. The real story might not be the crash itself. It's who may have used that chaos to quietly reposition. There are growing signs that major bank exposure, especially tied to JPMorgan, shifted right near the lows. And if that interpretation holds, you're not just looking at a violent sell-off. You could be watching the end of a pressure regime that's defined silver for years. Stay with me because I'm going to show you how these resets happen, what clues professionals watch for, and how you can recognize this pattern long before headlines catch up. Before I explain what caused this, let me teach you something most retail investors never fully grasp about futures markets. Prices don't fall in a neat, rational line. They cascade when leverage gets squeezed. Think of the market like a crowded theater where too many people are standing near one exit. Everything feels fine until someone yells fire. Then liquidity disappears, bids vanish, and suddenly everyone's trying to fit through the same door at once. That's forced liquidation. Here's what you need to know. Silver isn't just a physical metal, it's also a massive derivatives arena where paper contracts can outweigh available supply many times over. So when volatility spikes and margin calls hit, traders don't ask what the metal is worth. They ask what they can sell right now. Understanding that distinction is how you stop reacting emotionally and start reading the structure underneath price moves. Now, when a professional looks at a crash like this, they're not asking why it happened. They're asking who survived it, who was forced out, and who stepped in. That's the signal. If this is making sense so far, drop a comment and let me know you're following along, because what I'm about to show you next is where it gets really interesting. Now here's what's actually happening beneath the surface. Data from COMEX showed unusual delivery activity clustering around the $75 to $80 zone, precisely where the liquidation wave was most intense. Let me break down the sequence for you. First, price begins to drop fast enough to stress leveraged longs. These are traders who borrowed money to amplify their positions. Then, margin requirements rise automatically. The exchange says, hey, volatility just jumped. You need to post more collateral. Traders who can't post that collateral get forced out. That selling pushes prices even lower, triggering more liquidations. It becomes self-feeding, mechanical, almost surgical. You've got to understand how this works in practice. A trader might have been comfortable holding a position when silver was at $110. But when it hits 95, then 88, then 82 in a matter of hours, their broker isn't calling to ask if they want to hold. The broker's selling them out, automatically. It doesn't matter what the trader thinks the metal's worth. The system's protecting itself. That's why crashes accelerate. It's not sentiment. It's mechanics. Secondary confirmation comes from contract movement. Large blocks changing hands when liquidity is thin. That's not where panicked traders operate. That's where balance sheet players step in, because they can absorb size without blinking. They're not worried about a margin call tomorrow. They've got the capital to sit through volatility, and they know that when everyone else is scrambling for the exit, that's when you get the best prices. You see these big block trades showing up in the tape right near the lows. Not emotional selling, calculated accumulation, and convergence is what matters here. When you see both disorderly selling and structured positioning at the same price band, it often signals transfer. Weak hands to strong hands. The leveraged specs who got caught are selling to entities that planned for exactly this scenario. They've got watch lists. They've got limit orders staged at specific levels. They're not reacting. They're executing. But here's the part that should make you nervous. If a dominant short reduces exposure into a crash, future downside fuel shrinks. Shorts are future buyers, remember? Every short contract is someone who eventually has to buy to close that position. Remove enough of them, and the market can become hypersensitive to physical demand shocks. The buffer's gone. That means when buying pressure does return, whether it's industrial demand or investor flows, there's less resistance above. The spring gets compressed differently. And here's what very few people are talking about right now. These transitions are invisible in real time. By the time consensus recognizes them, price has usually already moved. You'll see articles 3 months from now saying, "Analysts now believe the bottom formed in early..." Yeah, we know. We were watching it happen. Your job is to learn how to spot these shifts as they're unfolding, not after everyone else figures it out. This is the exact same playbook that surfaced during the 1980 silver collapse after the Hunt brothers episode. You remember that story? The Hunt brothers tried to corner the silver market. Prices spiked to $50 an ounce, then crashed spectacularly. But here's what's important. Prices didn't just fall. Positions reset. Stronger participants emerged with cleaner books. The market purged the excess. And if you look at what happened afterward, industrial users who actually needed silver were able to access supply again. The mania was over, but the metal didn't disappear. Then look at 2011. Another vertical spike followed by a brutal unwind. Silver went from $18 to nearly $50 in less than a year, then gave back most of those gains. Many people interpreted it as the death of the bull story. Silver's done. It's over. The dream's dead. Yet industrial demand never disappeared. Solar panels kept needing silver. Electronics kept needing silver. What changed wasn't the fundamental use case. It was leverage getting purged from the system. The tourists left. The people who bought because their neighbor was making money, they sold and never came back. But the underlying story kept grinding forward. Zoom out and you see the pattern repeating. We confuse structural clearing with fundamental destruction. Every time positioning gets overcrowded, the market eventually forces a reset. It's painful in the moment. It feels like the end of the world if you're holding. But it's necessary in hindsight. Because markets can't function with infinite leverage. At some point, the system has to clear. And when it does, it's violent. Now let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this interpretation be wrong? Absolutely. Position data can be noisy, and banks hedge in ways outsiders rarely see fully. They've got over-the-counter positions, they've got options strategies, they've got swaps that don't show up in the public commitment of traders' reports. So when we look at COMEX data and say, look, short interest dropped here, we might be missing half the picture. It's tempting to jump straight to manipulation narratives. The banks crashed it on purpose. They're evil. They control everything. Maybe. But here's the thing. You don't need a conspiracy to explain mechanical liquidation. Markets are perfectly capable of creating their own chaos. You get enough leverage in the system, you get a volatility spike, and the dominoes fall on their own. No shadowy figure needed. So focus on what you can control. Watch positioning. Watch liquidity. Watch how price reacts after the panic fades. If silver stabilizes instead of cascading again, that tells you far more than any rumor. There are probably 3 types of people watching this right now. Some of you are stunned holders wondering if this is the beginning of something worse. You bought silver at $90 or $100, or maybe you've been holding since $70 and you just watched a huge gain evaporate in hours. I get it. Volatility tests conviction. But ask yourself this. Has the long-term driver actually changed, or did leverage just get flushed? If your thesis was that electrification and industrial demand would support silver over the next decade, did that thesis break today? Or did a bunch of traders with too much margin just get wiped out? If the thesis is intact, discipline matters more than emotion. You don't sell the bottom because it feels scary. You reevaluate whether your reason for holding still exists. Others of you are sitting on the sidelines thinking, did I just miss the opportunity of the decade? Should I be backing up the truck right now? Maybe, maybe not. Markets often retest zones where trauma occurred. Price might stabilize here at 78, rally back to 85, then retest 78 again in 2 weeks. Patience is a position too. Let the structure rebuild before you go chasing momentum. If you're not in, you have the luxury of waiting for confirmation. Use it. Don't let FOMO make your decisions. And then there are the pattern watchers, the ones asking whether this was a regime shift. You're not emotional about your positions. You're studying the behavior. For you, the signal isn't the drop. It's what happens next. Do rallies get sold aggressively, or does price start absorbing supply? Does every bounce get faded, or do you start seeing buyers stepping in earlier each time? Strength after shock is information. If silver holds 75 and builds a base, that's different than if it breaks down to 65 next week. Context matters. So here's what I want you to answer in the comments. Which type are you? Are you holding and sweating? Are you waiting for entry? Or are you just watching the pattern? Let me know because I'm curious who's in this community and how you're thinking about it. Universal principle no matter where you are? Don't trade the headline. Trade the behavior that follows it. The headline is noise. The behavior is signal. Here's where I stand personally. I'm not treating this as random panic. I'm treating it as potentially structural. Let me tell you what I'm watching. First, I'm watching post-crash liquidity. If bid-ask spreads tighten back up and volume normalizes, that suggests the market's digesting what happened. If spreads stay wide and volume stays thin, that's a sign of lingering fear. Second, I'm watching whether commercial positioning continues to lighten. If the next commitment of traders report shows further reduction in concentrated short positions, that confirms the transfer hypothesis. If shorts rebuild immediately, then maybe this was just a temporary flush. Third, I'm monitoring physical premiums. If you start seeing premiums for physical silver coins or bars spike relative to spot price, that tells you the paper market crashed, but physical buyers are stepping in. That divergence is powerful, because this event looks mechanical to me, not emotional. The fundamentals behind silver didn't evaporate overnight. Industrial use is still growing. Electrification demand is still real. EV manufacturers still need silver for components. Solar installations are still expanding. Mining supply is still constrained. None of that changed between yesterday and today. What changed is that a bunch of leveraged positions got cleared out of the system. If history rhymes, and I think it does, violent clearouts often plant the seeds for the next major move. Not immediately, maybe not even in the next few months. But once the leverage is gone and the weak hands are shaken out, the market can move on fundamentals again instead of on forced liquidation. And when that happens, moves can be surprisingly strong because there's no overhead supply from trapped longs trying to get out at break-even. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the data yourself. Don't take my word for it. But do learn to recognize these patterns, because the market whispers before it roars. If you made it this far, you're the kind of person who thinks critically instead of reacting emotionally. That mentality will serve you well, not just in silver, but in every market you ever trade. Share this with someone who needs to hear it. Subscribe if you want more breakdowns like this. And stay sharp out there, because we're living through the kind of volatility that separates those who understand structure from those who just chase price. Think critically, verify the data, and most importantly, learn to recognize when the game is changing, not just when the price is moving.